This Week in Startups is brought to you by Roman. Erectile dysfunction used to be tough to talk about, but now there's Roman. Go to getroman.com/twist to get $15 off your first order of ED treatment, a free online visit, and free 2-day shipping. Dell's Precision and XPS product lines can bring your vision to life. They are masterfully crafted from premium materials like machined aluminum and carbon fiber. You can also sign up for a free IT consultation at launch.co/Dell. And OurCrowd helps you invest early in pre-IPO companies alongside professional VCs. If you're interested in investing, you can join OurCrowd for free at OurCrowd.com/twist.
Hey everybody, welcome to This Week in Startups. Very excited to have our next guest on, who has made a lot of noise in the last year or two on Twitter, doing a number of different projects, from a rolling fund to buying out his investors to dunking on everybody in every direction on Twitter. And
not via VC brags.
Not VC brags. He's not VC brags, nor am I, but we do appreciate satire, I think. And his name is Sahil Lavingia. Lavingia is how you pronounce it. Lavingia.
Yeah, Lavingia.
What's the origin of Lavingia? I'm just curious. I've never heard the name. Lavingia.
Yeah, it's pretty unique, and I don't know exactly, but I think it means loving it's like bean, and Ia is kind of short for like wala, which means seller in Hindi. So I think it's like person who sells beans or something, or fireworks. Apparently, is the other one I heard, which sounds cooler.
Lavingia. Yeah. So if you ever are thinking of a startup and you want to create a marketplace for fireworks, which you can't buy fireworks online, can you?
Yeah, that's a good opportunity.
Oh my Lord, it's a great opportunity. So where to begin? You're an entrepreneur who then got into investing and then has recently, I think we should start with what's most recent and most interesting.
Yeah.
You have a startup, Gumroad, and tell everybody what Gumroad does.
Yeah, so Gumroad helps content creators sell digital products directly to their audiences. So we help musicians, designers, writers, filmmakers, photographers, all sorts of different types of creators sell digital products, online courses. Now we have a memberships product to sort of D2C.
Got it. So if I wanted to sell my podcast or my blog posts or any number of items, photos, videos, whatever it is, a course, instead of just setting up a website and a Stripe and a Typeform or whatever, you have that all in one package to manage easily.
Exactly.
And I guess there's Review, which was bought by Twitter, does this for newsletters. Substack does it for newsletters. I'm trying to think of your contemporaries. Ghost, I guess, is a platform that
Ghost, Patreon, Teachable. It's a pretty busy marketplace.
Right. And how did you came up with this idea how many years ago?
In 2011, I wanted to sell this pencil icon that I designed in Photoshop to my 2,000 Twitter followers. And it was just a pain to hook up all these things together and use PayPal. And, this is pre-Stripe. And so, yeah, that's kind of the origin of Gumroad.
So very interesting. I remember you raised a bunch of money from Kleiner Perkins. And the business, correct me if I'm wrong, it kind of stuttered or didn't get traction in the early days, and then had a couple of bumps in the road?
Yeah, so we raised the money, and it was a hot deal, so we raised our A sort of pre-product market fit.
Wow! Congrats.
We raised sort of $7 or $8 million, and spent it was just me at the time, so it was like we had 3 or 4 years worth of runway before we had to go out and raise. And I thought everything was great. We were growing. I mean, we were definitely up and to the right, but up and to the right is not enough for most VCs.
I thought up and to the right was the idea here. Up and to the right, not fast enough?
Yeah, like not compounding month over month, more like, growing 60, 80% year over year, 3 years in. So
you were slow growth in our industry. Generally in our industry, you're an investor now. People are looking for, in the early stages, 2 or 3x year over year.
Yeah, exactly.
And you were behind that, but you weren't not growing, so that's a good thing. And then a lot of activity started many years after you started this process. And I guess maybe you were early. Would you say you were early?
Yeah, I think we were early to a degree. Like, I think the creator economy, especially with COVID, has seen a huge uptick, just generally. So, we wouldn't have been able to raise at this price like even a year ago, right? Like, I think it is really this kind of new a lot of macro shifts that have happened. Yeah, I think it's mostly we were early, and mostly like I didn't understand. Like, I didn't do enough market research. I didn't really understand like how early it was and how small the market was, and how, like the LTV of a creator is very different from the LTV of a startup, right? And so I saw Stripe and I was like, oh, we're going to be like Stripe for this new market. But that new market was, absolutely tiny, and still is, even today, it still is very, very small. And I hope that it's early days, for it.
And just recently, like, at the taping of this, 48 hours before I think we started taping this episode, you on Republic.co, which is an equity crowdfunding site, launched one of the first $5 million equity crowdfundings because as part of the SEC's, was that the Jobs Act? They did crowdfunding regulations and they expanded it. It used to be you could raise up to $1 million a year, but now it's gone up to $5 million a year. Is this the first time you've done an equity crowdfunding raise?
Yeah, it is.
Tell us about the process. Why did you choose to do this as opposed to going to VCs? And then how did it go?
Yeah, I mean, I think Gumroad is a great business that's growing. We grew 97%, I think, last year, or 87% or something last year because of, in large part due to COVID. And so I think we have a great business. It's just still not venture capital scale in my view. And we're profitable. We made $1 million in profit last year. So I just thought it would be nice to have a little bit more money, but I don't need to raise money from VCs. And I have sort of built a lot of this stuff out in the open in the last few years, ever since I wrote that post on failing to build $1 billion company. And I just thought it fit very much in line with like what I care about, which is like, and a lot of what you care about, right? Which is like democratizing the ability to invest in early stage tech companies. And I just felt like I'm a VC now with a rolling fund. I have a startup that I run too. Like I'm well positioned for this. And so when I saw that the Reg CF changes were happening to increase the limit to 5 million on March 15th, 2021, I was like, cool, let's do it. Like, let's do it. The minute it goes live, it makes, let's start it off with a bang. And I hope it continues to grow and there are a lot more companies. But, to your point of like the process of doing it, it's like putting up a Kickstarter campaign, except you have to get audited by a bunch of people. And
the auditing basically just means accountants come in, lawyers come in, and they just fine tooth comb, make sure that almost like a public offering, because we did one for Inside.com, which is actually, I realize we're living parallel lives. I'm doing Inside.com, a content company. You have a rolling fund. I have a regular fund. I have the syndicate.com, the largest angel syndicate in the world, and you are now doing equity crowdfunding. So you don't have a syndicate though. You didn't start a syndicate.
I don't have a syndicate.
Well, it is interesting to be on both sides of the table. What have you learned now, and what do you appreciate about being on both sides of the table that you didn't appreciate when you were just a founder and weren't actually writing checks?
I definitely think, similar to you, I think being a founder turned VC is generally you have a lot. I think VCs generally have less empathy for the founders, just because the job of a founder is just I think way more brutal and multidimensional. Right.
I mean,
so
is there anything brutal about being an investor?
To be honest, no.
I'll be honest, no. I mean, like the most brutal day is like, I put a bunch of money of other people's money into that company. I put my name on the line and they totally dropped the ball. And I guess I look bad. Like that's kind of the worst day, right?
Yeah.
Is you kind of lose credibility because you made a bet that didn't pay off. But that's kind of like losing a hand of poker in a poker tournament. It's like, well, there's other tournaments and there's other hands and you didn't lose your whole chip stack. So keep playing the game.
Yeah. Yeah. Being a founder is like, going all in. You have one hand. Like you hope that it
and your entire net worth
every 3 years
in the pot. It's like, I just shoved my entire net worth into the pot. Please let these aces hold up.
Yeah. And, raising a Series A with, pre-product market fit is like, doing that
without looking at one card. You're like, oh, a king. Wonder what the other card is. Oh, deuce. That's helpful. Not suited. Fuck. I really need 2 kings or 2 deuces here, please.
Yeah.
So you hit. Let's talk about the scar tissue you have, because you've been super honest about it. It's like one of the things I was like watching you on Twitter. I was like, this guy is really noisy. and maybe on the margins annoying. And I was like, oh, wait a second. That's the definition of my career. I was like, but he's getting a lot of shit done. So we got to get this guy on the pod, and I need to know everything. So let's go right to it. Kleiner Perkins put all this money in. I'm not insulting you. I'm appreciating you. It's like the same thing. It's the same criticism of me. They're like, this guy's just making it. Who's this spastic guy, Jason Calacanis, doing like 100 projects, a month? And it's like, I'm just trying to get something to stick. I'll be totally honest. I'm just trying over here to have something I throw at the wall not fall straight down. It can be awkward or embarrassing to talk about erectile dysfunction, ED. Usually we just brush it off, maybe we blame ourselves, but Roman is here to get the advice you want and the help you need with no shame. With Roman, you can get a free online evaluation and ongoing care for ED, all from the comfort and privacy of your own home. A healthcare professional will work with you to find the best treatment plan, and if medication is appropriate, Roman will ship you real medicine with free 2-day shipping. The whole process is super straightforward, it's simple, and importantly, it's discreet. Nobody knows what you're getting. It comes in a nice concealed package. So, erectile dysfunction used to be tough to talk about, but now there's Roman. And getting started is so simple. Just go to getroman.com/twist and you will get $15 off your first order of ED treatment, a free online visit, and free 2-day shipping. That's getroman.com/twist for $15 off your first order of ED treatment, a free online visit, and free 2-day shipping. GetRoman.com/twist. Thanks again to Roman for supporting This Week in Startups. So let's talk about the Kleiner relationship, because you detail this. Mm-hmm. Kleiner puts his money in, pre-product market fit. Always a bad idea to put a lot of money into a company before product market fit, because why?
Because, you're committed for the next at least 5 years of your life, and you can't really change. People say raising venture is like putting, gasoline on a fire or something, right? Mm. Like you don't really want to, or maybe like, a rocket ship or whatever, right? You don't want to like point that in the wrong direction. And then like 2 years later, but you kind of have to, when you raise that capital, it's very difficult. Like people say, you can raise more and just not spend it, but that's very difficult. It's very hard not to spend money if it's right there. And you have a team that wants, there's a lot of people who want this thing to work. And if you don't signal to everybody that you just raised from Kleiner and things are working, like you're kind of like, it becomes a self-fulfilling prophecy of it not working. So you just kind of have to go into it. And you basically see a wall in front of you and you're like, I hope I make it, like I hope I go fast. You don't slow down, you go faster, right? In
a way, it's like trying to take off, a pretty big plane on a very short runway. You're like, well, we got to hit the throttle and let's hope for the best. But most products don't get product market fit. So it is a much better alternative to put in $500K or $2 million, let the founder get to product market fit, get to 10K, 20K, 30K a month, and then give them the next tranche. That's what you do as an angel investor now, or an early stage investor, right?
Exactly. Yeah. You give them 100K, 250K, and they have a year, to figure out if this thing that they're building has legs, and then you can raise more capital. And I think looking back, I think I was just so new to Silicon Valley, and I just wanted that credibility and that kind of stamp of approval. And
it is a big deal, right? Like that approval means something. I agree with you. When I had Sequoia back me, I was like, whoa, I've arrived. And other people said that to me. Whoa, you've arrived.
It really, it's easy to sometimes like think that I'm a hypocrite because I'm like telling people not to raise money, but I've gained so much value from raising money, right? And I think you're totally right. Like the truth is, like people do care. Like people, Sequoia is putting real skin in the game. They have a reputation. Like they don't do these deals very frequently, and it does mean something. And it means something to your employees. It means something to your customers. It means something to press. It means something to future investors. Like it really does. It can really, really matter, right? And so when you have that opportunity, like when Kleiner sort of gave us the term sheet, we got another one from Index. It was kind of like so few people ever get this opportunity. Like, right. I have to take. You don't even think about it because you're like, this is such a rare thing. And I'm like, I was 19, I think, at the time, and I was like, 19? Wow, I can lock this thing down, and
that's a big deal, dude. To get that level of venture firm, you're absolutely correct that. That's like being 19 and they're like, would you like to play Batman or Superman? And you're like, okay, well, those are career defining, roles. I'll take Batman. Like, what are you going to do? You have to take the role. It's just too big of an opportunity. And then you started running out of money at some point, and you did
2014.
You're now sitting there as a 23-year-old founder.
No, now I'm 20. Oh no, back then?
Yeah.
I was 22. Yeah, 22, I think, at the time.
You're 22. You're staying up at night staring at the ceiling. You got that thing in the bottom of your stomach like, oh my God, I took the role of Batman and this film's going to suck. And I'm running out of money. Did you have that like disastrous feeling?
Yeah, I remember I was so naive. Like I went into, I had some VCs that I considered friends. And so those are the first people I talked to when I was thinking about the Series B, in 2015, late 2014. And I remember the first meeting I was in Coupa Cafe with John Lilly from Greylock. And he was looking at the deck and he's like, amazing product, amazing team. You're fucked. Like he didn't say it exactly like that, but he was like,
how
you're going to
exactly
have a hard,
were
like,
you effed? What was his explanation to you of why you were completely effed?
It was just like Josh Koppelman has this quote, there's nothing like, numbers to fuck up a good story. Right. And I think there was just too much data that showed that Gumroad was not working. It was like not going to, if you have a 3 or 4 year old company with a bunch of people, you've shipped a ton of product and everything else is working. So, like it should have worked, that it just like the market was just not there. And, I think we grew like, 60% in 2014 or something. And it was just like, you're not like,
what would you need to clear a market in your mind, do you think?
I need at least 2x.
At least 2x, yeah.
And probably more, because we had done the A from Kleiner and it had been 3 years since that round. Mm-hmm. And so the B would have had, to have been like a kind of an interesting kind of thing. I think 3x is probably closer to what it should have been, because we weren't even at, I think, like $1 million ARR at that point, right? Like it was early in the life of the company. It turns out, I didn't know it at the time. I thought it was near the end of it, but luckily things worked out.
So you wind up signing a fateful bridge round with Kleiner.
Yeah.
Oof.
Yeah. We I went back to Kleiner and I was like, this looks difficult, and I frankly wish that Kleiner had given me a heads up that this, I thought they would have known this sort of thing before, but I guess they have a lot of investments. But yeah, they gave us a bridge round. They said, like, you don't have to let anyone go. Like, just like take this money. It was $2 million at a 4x preference. Gave me a year with the team. And I told the team this
4x
too.
Preference means they get $8 million back before that converts into equity. So they're guaranteed to get 4 times their money back in any sale. Company sells for $8 million, they get that first $8 million.
Yeah, exactly right. So we had raised, with the bridge and everything, at that point, a little over $10 million, but we would have had to have sold for at least 16.5, I believe, to have, for any common stockholders to kind of get anything.
And this is where the details of funding rounds really matter. And those liquidation preferences are generally a signal that the VC wants to protect downside. And they actually don't happen all that often in the last decade, because they'd rather you just shut the company down, correct?
Yeah, no, I think you're right. Like when you start getting into bad terms, it's not even worth it, right? Like at some point it becomes and I don't know why Kleiner did it. I'm grateful that they did, but like it sort of becomes a self-fulfilling prophecy. Like once you have something like that on your cap table, unless you really, there's a miracle in the next 6 months or so.
Yep.
It was not going to ever work. And I should have, in hindsight, said, maybe we'll do $1 million bridge, but we need to let half the company go and give us, 2 to 3 years more, 9 months to figure this thing out.
Clean terms, you probably learn now, are the goal for a reason, right? Because you just said it kind of screws up future fundraisings to have some funky 4x liquidation preference on the cap table.
It does. And I think, as an investor, I'm grateful for that experience, because I tell founders this all the time. And I'm like, I'll pass on a company that's giving me amazing terms, because I'm like, these are too good. Like, you're taking this, like, this is short term, or it's too good for me, right? It's like 40% dilution at a seed round. And I'm like, look, this is going to make your life very, 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 very difficult. You don't see it yet. But but when and certainly a lot of this stuff doesn't matter if you're Clubhouse, right? But like most companies are not. And,
no.
And you got it's just, I think when you're in it, you're like, you just kind of start to believe that a little bit too much. You know, I was 19, had raised $8 million from Kleiner and Naval and Max Levchin, and I was like, I have a shot at this.
Mm. Tell me, so the company then buys out Kleiner, or Kleiner gives you the company back? How did that go down?
Yeah,
it's kind of the dream, isn't it?
It is. Frankly, I mean, it is. What happened was, so we did the bridge. We tried to make it work. You know, I spent 9 months like pitching the company. I think I met with 150 different VCs, because it turns out when Kleiner leads your A, like every firm will take the meeting, even though they don't plan on doing the round, right? So I just had so many meetings that went nowhere. But
fool's gold, right? It's like it's fool's gold. Yeah, you have.
It doesn't matter if you're 90% of the way there, right?
Yeah. You've been anointed in Silicon Valley, so people are like, oh, maybe that is the next Google, since Kleiner did Google Series A. So I have no choice. I had the same thing happen to me with Mahalo, which then became Inside. After the Sequoia announcement, my phone just went off the crazy, and there's a group of VCs who follow, Kleiner in their heyday, and then everybody, and then my Series B went through like boop. I raised a $16 million Series B at a $100 million valuation before we launched the product.
Wow.
It was crazy.
That's crazy. That is crazy. And yeah, I mean, so we did this round of layoffs in October or so of 2015 after trying for 9 months to raise money and failing. And then we went from 20 to 5 and then 5 to 1. And I just basically ran it like a lifestyle business, I guess, for years, for at least a couple of years. Would hire contractors back, to fix bugs, hired a support person, but everyone kind of just like consulting for the company. You
went into cockroach mode.
It was cockroach mode for at least a couple of years. I moved to Provo, Utah from San Francisco and I was basically oil painting like full time. And then I would, kind of check in on Slack every once in a while. And
you mean literally?
I was burnt.
Oil painting is not a metaphor in this case.
Yeah. In this case, I was like, what's the opposite of a hyper growth, high scale technology startup? Like oil painting, traditional oil painting.
Really? Yeah. That's fascinating. What did you paint? Landscapes?
Landscapes. Yeah. I would literally just go out, see a barn and paint the barn. And then.
How long did it take you to decompress from the stress of those 5 years or so?
I would say, I mean, I really think that when I published that failure post reflecting on my failure to build a $1 billion company, that was February 2019. That is roughly how long it took.
Wow.
And it not only took the time, but it took the distance, because I was an SF from 2015 to 2017. So I was still there. But when you're an SF, like with like as a sort of quote unquote failure, like,
oh, it's brutal.
You're just and it's not to anyone's, it's not malice, but it's like, why are you here? Right. It's like going to a party and being married and people are like, what are you, you don't really need to be here right now.
Yeah.
Like,
you're married. You got kids at home. What are you doing here? You're at spring break.
Spending $4,000 a month, like living in SF for like, no reason. Like, so it was the distance. I think it was hanging out with people who like didn't care about startups at all. That really helped me, I think, realize like, oh, maybe I shouldn't either,
So you were able to put things in context, the success, the failure, the ups, the downs. And then at some point I see you pop up with this new device that AngelList comes out with called a rolling venture fund that my understanding is David Sachs and Naval came up with this concept. David Sachs, bestie from the All In podcast and who's on the board of AngelList. And so tell me, what is a rolling fund? When did they contact you about it? And when did you decide, hey, I should be a venture capitalist since I totally failed and got my ass kicked and had to go.
Worked out for Jason. So.
Yeah, worked out for that kid. Might as well. I went the slightly different route. I took the scouts route, but yeah. We call that in poker, chip in a chair. You have that chip. You know the story, chip in a chair, right?
No, I don't.
Oh, it's a famous poker situation where this guy made a bet. He thought he was going all in. And so let's say he had $10,000 in chips. So he takes the $9,000 in chips and he bets it. But he assumed he went all in. He didn't see the chip that was wedged under the table. It was out of his view. The other people could see it. He puts the $9,000 in. The hand plays out. He loses. He gets up. And then a person points and goes, you still have a chip. He takes the $1,000 chip out. He throws it out. He wins the hand. Now he's got $2,000. Or no, he wins, the hand, and he two people had called him or whatever, and he wins $3,000. And then he's like, well, this is meaningless in this tournament. The average stack is, whatever, 20,000. So he just, waits a hand or two, and he just throws the $3,000 and doubles up again or triples up again. And then he winds up making it to the final table and, of course, winning the tournament. Chip in a chair. You're never out of the game if you have one chip, right? And that is just so important for people to realize, because you are the manifestation of chip in a chair, which we'll get to in a minute. How can Dell's Precision or XPS line of amazing computers bring your vision to life? Well, whether you're a creative enthusiast or you're a professional, find out which brand is right for you. XPS and Precision products are masterfully crafted from premium materials like machined aluminum and carbon fiber. They're just stunning, and they deliver the perfect balance of size, weight, and durability, because we're all going to be getting on the road again. I can't wait. So explore how far your passions can go with Dell laptops, desktops, and workstations that are optimized for your creative endeavors. And everybody's getting in on creative work. Everybody's making videos now, logos, design. And as the world's #1 monitor company, I didn't even know that, Dell has the perfect monitor for you. I am using right now this gorgeous, I think it's 49 or 50 inch Dell monitor. It is stunning. Beautiful widescreen monitors change everything, and they come curved now, so they look really great. And they'll elevate your creative vision with 4K, 8K, HDR, and of course, my favorite, the really beautiful curved displays that have a wider gamut of all of the premier colors that you want to see. So Dell for Entrepreneurs is here to help with any IT projects you have. Go to launch.co/Dell and sign up for a free Start IT consultation. Thanks again to Dell for sponsoring This Week in Startups. Gumroad just chugs along while you're painting oil. I know you do the rolling funds. We'll talk about that in a minute. But to dovetail with where we started, at some point, the business starts growing again. When does it, or did it just always grow 60% and then you wake up one day with a $5 million business?
What happened was, so we grew around 60% in 2015, 2016, or whenever it was. In 2017, this is like, we had no blog, we had no Twitter, it was all inactive. And the test was like, will this keep going? Right? Let's just see if it keeps going. If it keeps going it would have to be a long time. But I don't need to shut this down preemptively, right? I can just let it do its thing. In 2017, we grew 15% year over year. In 2018, I started hiring a couple folks and shipping features again and fixing bugs. We grew 25%. In 2019, we grew 40%. And in 2020, we grew, I believe it ended up being 87%.
Wow. So you almost got your double up, and now you're sitting on a business that's doing
9 years in.
Well, I mean, it is really chip in a chair. You thought you're out of it, and then it starts every year doubling or tripling or, whatever. Every 2 years, doubling or tripling is basically what's happening here. All of a sudden you break in 2020, $10 million in volume a month, right? Mm-hmm, and then you make, what do you get, 30% of every transaction or 20% of every transaction?
No, we take a lot less. So we take 7%. But still ends up, we're at 10 million. We're actually at 12 million now annualized revenue.
Is that the 7% or is that the top line?
That's the 7%. So the top line is around 180 or so million a year now annualized.
What are people buying $180 million with? What's the top 2 or 3 customers, products, things being sold? I'm curious.
Well, it's all, it's all a plurality, right? There's no majority. There's education software, people learning how to code, people learning design, videos, YouTube stuff. There's ebooks, documentaries, comics. It's all over the place, which is kind of why I think Gumroad is. Yeah.
Did you win because you had the lowest take rate? Because I know Patreon was at 10% and they tried to go to 15 and the audience went crazy. I know Substack's at 10. Ghost charges SaaS fees. I'm thinking about moving the launch ticker to Ghost to just, because they have a newsletter / stuff. It's
a good idea. I've heard really good things about Ghost.
Yeah. But that's just I think for newsletters. So did you win by lowering that take rate and then people just picked you because it's got all the same features and it's good, but it's 30% less or, depending, maybe even 2/3 less?
Yeah, I think that's a big part. And, definitely the advice VCs will tell you is don't compete on price, right? Like that's dangerous. But we did, and it we made it up in volume per se, right? Like it took us a long time to make it interesting, but we finally got there. I did say the other thing is like I've always been focused, probably too focused if you care really about growth, on just like tiny creators, like helping people get started, like the on-ramp of the creator economy. Like what's the easiest way to sell a PDF on the internet to your Twitter followers? Then you can worry, if it works, you can worry about all the other stuff. And frankly, like a lot of people churn, like a lot of people graduate to some of these other products and platforms because they have a lot more functionality. I hoped over the next couple of years to play catch up. We're kind of playing catch up, right? But we have a couple years to get out of the hole in terms of tech debt and stuff.
What happened with Kleiner? They just gave you the company back for $1, or you buy their shares back for $1 so they can take the loss against all their gains, phenomenal gains they had as a firm.
Yeah, in 2017, I told Kleiner, I emailed all our investors. One thing I had done this whole time is I was just updating my investors, like I'm moving to Provo and learning oil painting. I need a break, and everyone's like, cool, whatever, go have at it, whatever, And I emailed Kleiner. I'm like, I want to open source this whole thing. Like, it's not going to be a significant business. We worked really hard. Like, why not just give it away and see what happens? Like WordPress style, right? And
beautiful.
And they were like, like this is weird, but like, you can do whatever you want, but like we still own IP. Like it was a conversation where I kind of was trying to get them to say, let's just write it off.
Yeah.
And they said no. And then months later, I get an email from them out of the blue. I put that email in that failure post. It's just like, it's literally just that one line. It's like, we want to buy back the shares for $1. Do you want to talk about that? And I was like, or sell the shares, right? And I was like, yeah. I literally was on the phone. I was just like, what's the catch? I mean, like you invested $7 or $8 million. Like, why are you selling it back for $1? I never really got an answer.
The
tax write-off.
It's a tax write-off because if they have this loss, like let's say they had Slack or something and they made $1 billion in Slack. Now they've got $7 million in losses that they can take against that, and that's how tax works.
So they're kind of, if you're a good fund like that, you basically are guaranteed on your downside to limit it to at least your tax write-off that you'll be able to get out of it. Like, I mean,
imagine, and also it gives closure. Imagine you're sending, like for example, with Mahalo and Inside, now in the second decade, it hasn't had an outcome for folks, but it's doing well enough. And at some point, Sequoia's got to close that fund because now we're in year 12 or 13. So it's like, come on, JKL, hurry up. And then at some point, they might say to me the same thing, like, hey, here's $1. Let's just, because they want to wrap the fund. But now I think people are starting to get used to funds being maybe 15 or 20 years because you could have things that hang out there and then all of a sudden have an uptick. And, the founders who don't give up sometimes thrive. And that's why I'm big into resiliency and I have a lot of respect for what you've done. So you buy it back, they get the write-off, great, everybody's cool. And then you decide, you have all these folks who love the products. You decide you're going to do this equity crowdfunding thing. Republic contacted you, you contacted them. Yeah. How did it go down?
Yeah, well, the rolling funds kind of happen in between this. Sure. But we can get to that. But like, yeah, basically what happened is I was like, I think creators should just own this thing like over time. And so I tweeted out in like last year, I think, or the year before last year, 2019, I said, what's the right way to do this? Is it crypto? Is it LTSE? Is it something else? Like, this is when Reg CF was still very new and you could only raise $1 million. And I looked at it and it would basically cost, I think you did it right. It costs a significant amount of capital to just do the $1 million round. Like if you can raise $1 million from VCs for free off safes, like that's a way better outcome. And so we had a conversation and we just never really did anything with it. And then when Gumroad started growing faster in 2020 because of COVID and I had this new audience from kind of just tweeting about the failure stuff and all that. Like I was like, this is perfect. I mean, we can take advantage of this Jobs Act, these new changes that are coming live, and be the first and just kind of hopefully, quote unquote, I wouldn't say pioneer it because people have been doing it for a long time, but be a really good case study, kind of like what I did with rolling funds, right? Like I was able to kind of show people like what are the benefits of this product versus just like what are the technical specs, right? And so I think that's kind of my goal with this crowdfunding round in large part is just to make crowdfunding cool and like try to make it a thing. Because I think it's important. I think you agree. Like more people should be able to invest in startups.
I've been trying to get this going, and it's so hard with the equity crowdfunding because there's $1 million cap. A lot of our founders are like, well, I'd rather just take $1 million or $3 million from accredited investors from the syndicate, have 150 people in one SPV rather than have 1,000 or whatever it winds up being in a crowdfunding. And well, that's capped at $1 million. Well, what, I don't want just $1 million. And then I have to do all this extra work to just get $1 million. So you're basically, this was the problem with the SEC's approach here. Or the challenge, I shouldn't say it's necessarily a problem, but it's a challenge because they're trying to balance protecting consumers while providing the opportunity. And every time you try to protect consumers, you create red tape. And you and I can go to Vegas right now with our entire net worth. You could put it on black, I could put it on red, and then it comes out double green. We both lose everything. Nobody educated us. Nobody told us anything. We put down $1 million each and boom, gone. And no recourse. Yeah. But if you want to put $500 or $5,000 or $50,000 or $50, whatever, into an equity crowdfunding, they have to be audited. They have to do all the stuff. And I understand why, but I think it should be, what my best advice to the SEC is to say, everybody gets to spend up to $5,000 a year on any product, any project or whatever. And any company can do up to $5 million. And there doesn't have to be, as much red tape or limitations, right? Just if you put the cap on the individual, you could kind of keep the crater of if there was a fraud or if there was an action taken or, anybody did something fugazi. What would the crater look like? $5 million or $5,000 per individual? It's not actually the risk of ruin for most people. People can recover from it, in other words.
No, you're exactly right. Like just say, it's 5,000 or 10% of your net income, whatever. Net worth,
net your revenue for the year, right?
Or exactly. Like, there's so many ways, frankly, to do it that it will happen. It seems inevitable to me, but it will take.
So how did it go? I didn't get the latest update, but you launched it on Monday of this week, March 14th or 15th or something?
15th, yeah, March 15th.
Which was that Monday? And today is today Tuesday? Wait, you launched it yesterday? Tuesday.
I launched it yesterday. Yeah, I launched it yesterday. At 9 a.m. PT. Okay,
so noon Eastern time, 9 Pacific. What does it look like at the end of day one, when you had dinner?
It was closed. It was
I'm sorry, did you say closed?
Yeah, it's $5 million we raised.
In the first day?
In the first 12 hours by 9 p.m.
I'll be right back. I got to go raise another round for Inside. I'll be right back. What the?
Seriously, no, you should. Yeah, you should.
It's incredible.
This is why I'm telling you, man. It's insane. And the cool thing is we did it, you have to do it. We did it in public. We raised $5 million. We sent updates by the hour on Twitter. Yeah. And to note, we had a $1,000 maximum check size. So we needed, we ended up with I think it's going to be around 7,600 new investors on the cap table or via an SPV. But it's amazing. If we had a no max check size and we could raise more than 5 million, like who knows what would have happened? It's pretty insane.
Do you ever wish you invested early in some of the best performing IPOs of 2019 and 2020? Well, OurCrowd investors did invest early in many of those awesome IPOs. With OurCrowd, accredited investors can invest directly and easily in startups early, before they IPO or get bought. OurCrowd investors have benefited from companies IPOing like Beyond Meat and Lemonade, both of which have seen pretty great returns since they've gone public. And some of the companies have been acquired by buyers like Intel, Nike, Microsoft, Oracle, and Uber, yum yum. The investment professionals at OurCrowd have already invested hundreds of millions of dollars in over 200 companies with dozens of exits. So here's your CTA, the old call to action. Today, you can join OurCrowd's investment in Shield, an AI-powered platform that helps global financial enterprises meet increasingly complex compliance rules. According to the deal memo, Shield addresses an $89 billion market with tools that automatically detect and alert on behaviors that lead to market abuse, employee misconduct, and information sharing. If you're in the finance space, you know all about this, right? You can get in early on Shield and other unique opportunities at ourcrowd.com/twist. I recently wet my beak and I placed a little bet on Cyabra, a company that uses AI to uncover disinformation and expose fake news on social media. The OurCrowd account is free. Just go to ourcrowd.com/twist. Okay, let's get back to this amazing episode. So what was the total number of investors in it?
70, I think it'll be around 7,600.
Of those, how many were Gumroad stakeholders already? In other words, the users of Gumroad on either side of the transaction. And did you email that list and say, hey, you've bought assets or you use Gumroad, would you like to invest?
Yeah. So what I did was I emailed the Gumroad creators and I said, hey, I'm doing I do these open board meetings on YouTube. So I said, I'm doing an open board meeting. FYI, if you want to invest in Gumroad, like you should show up to this, right? And so I kind of, the SEC, doesn't really like you doing this kind of thing. So like now it's actually allowed. So one of the changes that happened Monday, which I think is really, really notable, maybe even more notable than the 1 to 5 change, the 1 million to 5 million change, is you can test the waters. So you can generally solicit, which actually rolling funds like very, very aligned in that front now, right? And so I think now founders can you, for example, can go tweet. You don't even have to do anything. You can just have a Google form and it's like, hey, I'm thinking about doing this. These are the rough terms I'm going to do. Are you in? For how much? Do you need more info? Let's do a Zoom webinar.
I got to call Ken from Republic and congratulate him. Or maybe hey, do me a favor, team. Can we book him to be on the show? And let's talk to him about this. We'll chop it up. So now you have that 5 million. You raised it at $100 million valuation or something like that?
Yeah, 100 million pre-money.
Which is 10 times or so, 10 times your revenue, ballpark?
Yeah, around 8.5x it ended up being.
Oh, 8.5x. Okay, so in today's market, which is hot, that would be kind of reasonable, right?
Yeah, I mean, to be honest, like I can say this now that I'm not, the round's closed, so I'm no longer pitching the company. Yeah. It's cheap. It's very, very cheap. And the reason I chose it is because I really want crowdfunding to be a thing. And if I can show people, wow, these people got in at 100 million, really easy mental thing, right? Like if we become a unicorn, it's a 10x. And so I think it's just like a very clear story for folks to be like, oh, wow, like I could get in at this price. And I'd rather dilute myself a few more points, but then get, these 7,600 people a really positive return. And many of them, as you mentioned, many of them are our creators, right? So they're the reasons we even exist in the first place. And so, yeah, I think it was a good price, and it was anchored by Jason Fried from Basecamp and Naval from AngelList and some other folks.
So you lean on them. They put in 100, 250, 500 each, and that gets everybody. That gives you some social credibility, I guess. Yeah,
exactly. I mean, it turns out we probably didn't need it, but at the time, the concern that I had, and it's similar to how I think Chamath did it with SPACs, is he just tied his brand to it, right? Yes. And he just really put real skin in the game, and that's kind of what I wanted to do with these folks.
Why is that so important? Skin in the game.
Well, I think it's important because there's so much money flying around right now, like. It's just crazy.
It's stupid. Let's be honest. I mean, people are spending $69 million on an NFT. I mean, I'm not deriding the artist. I'm super happy for the artist, and I'm super happy for the buyer if they don't care about money, or they want to reward an artist with $69 million. I know that was a collection of work, but I mean, it is pretty stupid out there. Let's be honest.
There's been a lot of wealth creation recently, right? And that needs to get invested back into risk capital, which is effectively like tech companies and crypto, and that's it.
Apparently, it's also non-fungible tokens and Bitcoin and everything else. I mean, it's just crazy to think that somebody is buying the first tweet ever for $2.5 million, but I don't know exactly what you're buying. It's kind of like buying a baseball card, I guess. You don't have any rights. There's no way to monetize it except maybe to resell it. I'm interested to see, actually. That would be the ultimate test, is if that $2.5 million tweet or that $69 million NFT sell ever again for anything related to the purchase price now. What is your guess? In 10 years, you think either of those could be sold for more than they were bought for?
I think so. Yeah, I really do.
What's your thesis?
my thesis is, I mean, it's kind of paradoxical, I think, but like basically the value of it is created by not selling it, but to actually get the value of it, you need to sell it. And it's also just how many people know about it, right? Like, why is the Mona Lisa worth what it's worth? It's because everybody knows I can say that, and you know it would, so I think it's a self-fulfilling prophecy. Like, if enough people care enough about this for long enough, it just like, by the way, just like a startup, right? Like, just like reaching product market fit.
A startup might also have profits that would then be dividends that would then, you could buy it for future cash flow. So fair. That's why I think these NFTs with the art, if the art could be, art is delightful anyway, if you love it. But I think it's also a bit of a status game. That's what my thinking is. I think the people buying these, I believe they both uncloaked themselves. They seem to be playing a status game where they're using their ability to purchase that like somebody in a club who purchases 10 bottles of champagne and it comes on a float with sparklers is showing, I can buy $10,000 worth of champagne and not give a shit. It's, then everybody wants to come to your table and have some of your $10,000 champagne, which actually costs $500.
Yeah. It's the fact that other people care about it, right? It is totally 100% a status game. So that is just very hard to predict, right? Like, because who knows? It's like fashion. Like, who knows where it goes? Versus with if you're building a product, right, that has clear value, it's a little easier to predict that,
and distribution,
and profits, and exactly,
and a chance that somebody might buy it down the road. I mean, there's still a chance that somebody might buy it down the road. What I'm interested in is, do you have when you buy that tweet? If I bought that tweet from Jack, could I then, if I bought that tweet, make t-shirts and calendars and posters and license it to other people? Like, are you actually buying the underlying right to monetize it in perpetuity in all mediums and forms now created or in the future?
Well, the problem is you're combining two different worlds, right? Where there's this crypto world, which is all code and all these non-fungible tokens and sort of everything is in software. And then you have like IP, which is like litigated in real life in like the US, like trademark system, right? Like all the copywriting, et cetera. Like, so I think I think what you need to do if you wanted that to happen, right? If you wanted that to work in a way that was like fair and everyone was bought into it, you would basically have to figure out how to replicate every single thing that we figured out in contract law or in IP protection,
which
and
we have
replicate it in a crypto kind of way. Right?
I mean, if you think about it in terms of music, if you're Neil Young and you own, you own the physical tapes when you recorded the album Harvest, or the Beatles have the, White Album, and they have the physical tapes. They own those tapes. They may have sold the rights for the royalties, for the mechanicals or the performance royalties to other people. So they own the rights to the masters to exploit them commercially, but you actually have the physical tapes that were in the recording studio, but you can't then make albums out of it or sell it to Pepsi for a commercial.
Yeah.
Just to fill in the audience, the buyer of the $69 million NFT, which was done by the artist Beeple, is that his name? Beeple, was apparently an Indian crypto investor who has one name, Meta Kovan, and he is the chief financier behind the Metapurse. I'm guessing Metapurse is some kind of wallet. This kid has 18,000 followers on Twitter, and we'll get him on the pod. Metapurse is a crypto-exclusive fund that specializes in identifying early-stage projects across blockchain, infrastructure, finance, art, unique collectibles, and virtual state. So, as I predicted, this is a pump. Everything in this business is a pump. He is in the digital asset business, so he just anointed Beeple. Who knows how many Beeples he owns previously, or how many other NFTs he owned, or
he owns a lot of Beeples, by the way. He owns almost all of them.
So now we see what's happening. This is exactly what people in the art market do. The art gallery goes to their best clients and says, hey, this new show is coming. There's 30 pieces. Here's 15 of them. You can buy it at this great price. If you buy them right now, great. Thank you for the cash. Other 15 are there. Then people bid up those last 15 in their scarcity. Then those people sell 5 of those paintings, triple their money, and they got the original 10 for free. And the gallery got to turn over the inventory twice, and they got monetary velocity so they could take their vid. Yeah. And it's all that's classic pumping and dumping. I'm not saying he's dumping here.
to the fine art example is then you give it to a gallery or a museum,
and you get the tax write-off,
and then you get the tax write-off too, and
then you get the Kleiner dollar, you get the dollar email
on the value of this painting that it's been pumped, right?
Exactly.
You don't get it on what you bought it for. And so there is a lot of incentives here that I think are not necessarily good, but they will be replicated in NFT. It will just be, at least in that world, you should be able to see it all. It should be transparent, right? So if it's happening, you should be able to see it, and then you could argue if it's right or wrong. But at least in the art, it's more, I think, more sort of decentralized, right? Versus like
you wouldn't know in
fine
the
art galleries or whatever.
Yeah, you wouldn't know the fine art galleries were running this kind of scam, or you wouldn't know what the things actually sold for. And here it's all on the blockchain. And I'm not sure in the Beeple example, but what I love about the Beeple example, or the NFT example, is that you can set how much I get in the resale value. So I get 10% of the next one or the next one. So the artist has 10% ownership in their piece forever. So if that piece trades 20 more times in their lifetime at increasing value, they've essentially, if they're getting 10%, sold the entirety of the piece 2 more times. They got to sell it essentially 3 times.
Yeah, that is a very interesting idea.
Yeah.
That is a very interesting idea. Like this idea that these royalties almost are baked into that, like into that transfer of ownership. That is really interesting. But who knows? NFTs are, they're interesting.
Well, you started with digital assets, so that's sort of interesting. I wonder how you're thinking about NFTing or blockchaining Gumroad. Is that like in the back of your mind where you're like, I wonder if this is going to apply to courses?
A little bit.
Yeah.
Yeah, definitely. I mean, definitely, I'd listen to creators, right? And creators are very, very aware of NFTs because it's a way that they're seeing other creators make quite a lot of money.
Yeah.
Which isn't always good. It depends how many people, what's the long tail look like, et cetera, et cetera. But I think it's very interesting. We have no plans or, no commits to kind of pursue this yet. But who knows? It's so unpredictable. I think if there's a real market for it and creators want it, we'll build some way of, maybe you can either sell NFTs on Gumroad, or you can NFT the products you've already sold on Gumroad and say you have the one of one of this digital product that I've been selling for years, but now I'm doing the one for the one of one of it. And if that's compelling to people, then I don't know. For me, it's not a value. It's like whatever. Sure.
Okay, let's pivot over to the rolling funds. Tell me, explain to the audience what a rolling fund is and how it's different and distinct from both a traditional fund and a syndicate.
Yeah, totally. So, I mean, credit to David and Naval for this. It's effectively a fund that starts at zero, and you raise money on a quarterly basis, and you deploy capital on a quarterly, effectively, out of a quarterly fund. And so it's similar to a fund in the sense that it's a blind pool of capital. People give you capital. It's just, instead of a 2-year fund or a 3-year fund, it's an ongoing quarterly subscription, right? So it's like a Netflix subscription per se for a fund, which I really like. I think it's really clean for people who haven't done LP. Institutional investors are like, what the hell is this thing? But individuals are like, yeah, this is how I think about putting money into Vanguard or crypto. So like, this makes sense to me.
So it's a quarterly commit. Got it. Yeah.
Mm-hmm. You can do it openly, right? So I can tweet like I have a fund, which generally in venture capital you have not been able to do. And a lot of VCs don't do that because their funds aren't set up in that way.
And that's called, what is that, 506C or something?
Exactly right. Yeah, it's 506C.
So 506C versus 506B. Get your own attorney here, but the general rule is general solicitation. And general solicitation means what for somebody who doesn't understand this?
Yeah, it's basically you're pitching, you're selling, right? You're going to a forum of some sort. When the rules were written, it was literally like a town square. There's no internet in the 30s when these rules were put into place. But yeah, effectively, you would. I assume it was to prevent people from basically going to strangers and trying to sell them, like you see timeshares or the people on Clubhouse or whatever, right? It's that sort of thing that they wanted to prevent. So effectively, you could only sort of solicit on sort of in your own network. You would have to kind of like network your way into a fund, which as a non-VC person, like I didn't know how to do. I didn't really have, even though I was in startups and I raised money, like I didn't know what a family office was, right? I didn't know what an endowment. How do I still don't know, frankly, how I would get in front of a lot of those folks. So I think it just like allowing me to just tweet about it is like huge, because all these people, by the way, are in my audience. I just don't know who they are, right?
Right. And they don't know you're raising a fund. So
exactly,
the only way for you to actually raise money is for you to get an introduction to somebody or somebody to reach out to you, and you cannot generally solicit. And the reason this existed was they wanted to save people from, I don't know, being convinced to give away their retirement savings to some copper mine or gold mine in Albuquerque or something. I mean, literally, I think it's like, I think this comes from the Great Depression and like that era is my understanding of when these laws came from. So you start just telling people, I have a rolling fund on the Twitter.
Yeah.
And what happens?
Yeah, it was pretty insane. And just to give a little bit of context, the reason I started one was I tweeted out after the George Floyd protest, I tweeted out, I want to invest in Black founders. I got a bunch of emails. I wrote 4 checks. And then I 3 of them were looking for more capital. So I emailed Naval and a bunch of other folks saying, hey, these startups I invested in are looking for more. And Naval just replies being like, you should start a fund. I'll anchor it, help you get started. We have this new rolling funds product you could use. Start at 0, see where it goes. At that point, he was like, start at 0, use your network. At that point, openness wasn't really part of the conversation. I kind of introduced that to rolling funds. And I remember having a call with the Angels team, and they're like, do you want a 506B or a 506C? And I was like, what does the 506C get you? And they're like, you can tweet about it. And I was like, okay, that one, please.
Well, what's the downside then? Why doesn't everybody do it? Why doesn't everybody do a 506C as opposed to a 506B?
Yeah, it's a great question. Frankly, I think a lot of it is just like lack of awareness that it's possible. But there are two actual literal reasons. One is with a 506B, you can technically have up to 35 non-accrediteds. So if you wanted a bunch, friends and family into your startup or into your fund, that's possible. I don't know if anyone actually does it because I've heard the liabilities are still there, so lawyers will tell you not to. But really, the reason people don't do it is it's just burdensome, right? Like the reason you can generally solicit for a 506C is that you basically, after you generally solicit them and they sign up, you have to verify that they are accredited or qualified.
How does that occur? Verifying somebody's accredited.
Yeah. So in my case, for example, like I had to get my CPA to write a letter that says that I'm worth over X amount of money.
So somebody with an accreditation will then prove that you're accredited and put their CPA license, lawyer, whatever, on the line. And there are also now third-party services. I know Assure Fund Management, which I use for my back end. They have a service that does this, and I believe AngelList does it for you, right? Like, and I don't know if they charge $50 for it or what they charge for it, or if it's just baked into the cost of doing all this.
Yeah, it's baked in, and my guess is it will be standard, 5 years from now. I can't imagine, like, why not? Like, all this stuff should be automated anyway, right? Or as close as possible. And I have 200 LPs, and it wasn't a concern, honestly, to get everyone verified. It was, I think, more burdensome on AngelList, and they handled it for me. So yeah, it's pretty great.
Attorneys are always going to tell you to take the easy way. That is the least exposure. It's kind of their job, right? So, hey, you're gonna add risk, and they want to mitigate risk. But there is also the upside, and the upside is I'm watching you do this, and I'm like, at the same time you're doing this, I was closing Launch Fund 3, and I'm like, I got a bigger following than this kid, and he's out there talking about his fund. I can't talk about my fund. I'm going crazy. And they're like, well, you elected to do this, and so you have to stay in the lane. And I'm like, the next fund I'm doing what you did, I think, if I even do another fund. I'm not sure if I'm going to even do a Launch Fund 4 because I have the syndicate. It's growing so big. I don't know if I need it. It's like I could just do syndicate deals all day and you don't even need to have a fund. So it's really interesting how this new concept is really enabling people like yourself who've never done investing to have a fund. Where is the fund now? Every quarter you get how much money from these 200 investors?
Yeah, right now it's around $12 million a year. So it's around $3 million a quarter that I get.
So each person's putting in on average 50 to 100K per quarter or per
year. But I have 200 LPs.
200 LPs.
So the way it's set up, it's actually 2 funds. One's a QP vehicle and one's
qualified purchaser, which is people who have over, I think, 10 million in net worth.
5 million.
Oh, is it 5 now? Yeah. So 5 million in qualified purchaser. So they get treated another way because they're like they're beyond accredited slash, when you hear the word accredited, just think sophisticated or rich. And then when you hear qualified purchaser, you think really rich. Like Ricky Gervais, kind of money, like NBA player money, not just rich in Silicon Valley money.
Exactly.
So the other thing though is they have to pay in every quarter, and at any point in time, they can change their investment amount, correct?
Yeah,
so
exactly.
How many quarters into your rolling fund are you?
I'm on my third quarter now.
Have you seen people actually take advantage of that where they say, I'm feeling rich. Instead of my 10K a quarter commitment, I'm going to go to 30. Or, consequently, I need money for whatever. I'm, selling a home or got a divorce, whatever life events going on, buying a home. I'm going to take this quarter off.
Yeah. I have seen the former. I'm not sure if I've seen the latter. I've seen the latter once, actually, at least once.
Okay.
But mostly it's the former, and I think it's because people want to deploy more capital from the beginning, but now they can get comfortable, right? So they can start with 10K a quarter, and then 2 quarters in, like I've had people go from like 10K to 50K, and that isn't like a life of, that is like.
That's 5X. It's a big deal. I mean, it's basically going from 40K to 200K a year. I mean, you start, and then over 5 years, you're talking about the difference between 200K over 5 years or $1 million. I mean, and so in a way, I mean, I don't mean to say this in a derogatory way, but for new fund managers, and I am in my third fund, even with the massive success I've had, I mean, it's pretty ridiculous when you look at my IRR. I mean, I'm not trying to brag here, but I got really lucky with a couple of investments. I have a hard time raising from the traditional LP group, and they tell me they need more, evidence that I'm good at this, and I'm in year 11. When you're a new fund manager, first-time fund manager, you basically set up a $12 million fund, which is really the equivalent of a $36 million fund, because they usually get deployed over 3 years. And your first time up at bat, and
off a tweet,
and now you do that, and it's like, whoa, this is unbelievable. Like this rolling fund, and so the thing I was going to say that, would be, maybe some people would take this in a derogatory way. It's almost like a pretty short leash or training wheels where it's like, okay, and you kind of implied it yourself, like they trust you. So it's hard to trust a new manager because what if they're a total screw up? What if they give the money to their friends or they invest in non-venture businesses? Whatever, they tell you one thesis. There's a lot of trust involved in this. So instead of, in that example, the person giving you $1 million commitment for your fund, they started at 10 or 200K over the life of the fund, maybe. And then they upped it and upped it and upped it and upped it to the point at which they felt comfortable. Or conversely, if they're like, you're investing in companies that don't make any sense to me. How'd you pick these? They can then say, I'm out.
Exactly. Yeah. I think it has pros and cons, but I'm hopeful that, I have no institutional LPs in my fund, and I don't think I would be able to get them. Like they would have, as you mentioned, they would look at me and be like, "Come back in 15 years,"
Yep. Trust me.
And so I just think they don't get it, or they don't. It's just the risk like the risk is just too high by default. Just like the commitment that they intend to make, that they basically will only do it for people they've known for like 20 years, they went to school with, which inherently leads to a very homogenous community.
Yeah, it is pretty homogenous. I think it's actually even less pernicious than that. It's actually that they have a committee they go to. They can add but 1, 2, 3 funds a year. And the existing funds, let's say the really blue chip funds like a Kleiner, you've seen them do bigger and bigger funds. You've seen them do a scout, seed, Series A, growth, opportunity, secondary share, crypto. They all of a sudden come up with 10 different fund ideas. If you're some giant school's endowment and you say no to Kleiner's, 6th new fund, in your mind, this is what they've told me at least, I'll take Kleiner out of it, Acme Ventures. So Delta University has got a relationship with Acme Ventures. Acme Ventures comes up with 4 new products. And the firm, the endowment doesn't participate. They lose access to the ones they were in originally. So now they're just getting squeezed by, Andreessen Horowitz has like 15 funds in 10 years. And so what I've heard from them is like, we have to be in the next Andreessen fund or else they won't let us in the other ones. Therefore, there's no room for new fund managers. So essentially these giant funds have taken all the air out of the room with that set of LPs, which then leads us to be independent of them. So this is their big mistake. Someone like you is going to make their own way in the world, or me with my syndicate. And by the time one of those big funds wants to participate, it's like, well, we don't need you. And that's what I told them last time I went on the tour. I was like, you realize they're probably not going to need you anymore, because if the syndicate goes from 2,000 to 4,000 people, I'll have escape velocity. And now it's 7,000 people. So it's like,
You don't need them.
Yeah, exactly. This new democratization that we're talking about here, both from crowdfunding and from rolling funds and from syndicates, is just crazy. Do you tell them what you're investing in every quarter? Do you give them a quarterly report? How do you communicate to the rolling fund LPs what you're doing, or do they even care?
Most of them don't care too much. I basically email them once a quarter with an LP update saying, these are the 12 companies that I invested in. Here's some stats, median valuation, et cetera. And then I do a Zoom call. I'll probably do it on Clubhouse going forward. And that's it for another 3 months. So it's a very
And you were able to do the Series A in Clubhouse. Congratulations on that. You got your beak wet.
Thank you. I got my beak wet.
Yeah. Well, you got Mark Andreessen. Yeah. And you got Mark Andreessen as an LP in your fund as well. Congratulations on that. He's awesome. He's weird actually, but he's also awesome. He's a little bit weird.
He's smart.
Yeah, smart people get, when a smart person gets really rich, they get weird sometimes. That's Mark. He's super smart. Smart plus money, and then you just draw a line and it's like, weird. Blocks. He's an LP in my fund, then he blocks me, then he won't come on the podcast, but then he wants his partners on the podcast, and his PR person's emailing me. And it's just like, can we just have a normal relationship, Mark Andreessen? Like, why does it have to be so weird with Andreessen Horowitz? Such a weird firm. All right. Congratulations on your amazing success. Did we miss anything?
Thank you. What did we miss?
I don't know if we missed anything.
No, I think we got.
Are you happy? You seem really happy.
Thank you. That means a lot, honestly.
No, I see the joy on your face. You seem so engaged, and I know you had a rough patch. Maybe you could speak to, if you are in fact happy, this arc of a story we went through where you were, staring at the ceiling and then had to go paint oil paintings to get your head straight. What have you learned in all of this crazy Meshuggah and 10 years of, ups and downs? You have any advice for the 19-year-old Sahils out there coming up in the world?
I think when you're that young, you're kind of on that, your Y slope seems stratospheric, right? But more likely it's asymptotic. It's more likely that you maybe for some reason you had a little bit, but a lot of these prodigies, they're 8, you're at 8, they're 20, but then when they're 25, they're like everybody else who's 25 who worked hard to get there, So I think I just really wish I just told myself, like, you don't have to figure this thing out by the time you're 23, because Zuck did and Steve Jobs did, and if you don't, you're screwed, So be patient with yourself. I mean, it's kind of like what you said, like it's the chip on the table thing, right? It's just like stay in the game. If you enjoy the game, or if stay in the game as long as you still have conviction and enjoy yourself. Like, don't, I'm having a lot of fun.
I can see that. That's great.
The rolling fund, and it's and I mean, that's such a big part of it to me, because like, if, as you mentioned, like talking to these institutional LPs, like it wouldn't be fun for me, right? Like I would fail because it would be.
Imagine having somebody take every investment. Imagine in 5 years, somebody taking every investment you have, having 5 MBAs, do every form of spreadsheet, and then take the companies you don't even remember you invested in that were complete total screw ups and be like, tell me about this investment you made. And I was like, at one point, I'm in like one of the great halls of capital. And they're like, tell me this one. I'm like, great story. That founder absconded with the money and disappeared and ghosted us. And then we started getting all kinds of crazy legal notices about him not shutting the company down properly. And we still can't find him.
Wow.
And there's like 12 people in the room and they're like, what? And I'm like, yeah, we make 50, 100K bets. And, back then we didn't really do much diligence. Now we have a better diligence process. But yeah, that was a complete and utter disaster. It's like, well, I mean, what do you think can happen? You invest in somebody, they're 19, 20 years old, like Mark Zuckerberg was. Like, that's kind of how it works. It's really messy. And then sometimes it works out brilliantly. And then there's a spectrum in between of every permutation. But if you're looking for perfection, do not work with humans. And certainly not entrepreneurs and startups, early stage startups. There is no perfection here. If perfection is your goal, for the love of God, get out a chessboard and spend 10 hours a day just grinding it out on a chessboard because you will get to a 2000 rating and,
Well, I would say the other thing I would add is just like, it's such a beautiful time where anyone can build and can learn any skill basically for free on the internet.
Be careful, you'll get canceled for that.
I know.
You say
it's
that,
ridiculous.
What is that? So dumb. You're like, wow,
It's
the world is
ridiculous.
so much better
Oh my
now. And they're
gosh.
like, no, it's not. And it's like,
It sucks.
Are you sure?
No, it's pretty good for me.
pretty great.
it's
And the
so-
last time I checked, I don't think you're a cis white male.
No, I'm not.
I mean, I can guess you're a male.
Unfortunately, I think.
But I don't want to make any judgments here. But I mean, if you literally say that, every skill you can get online, people lose their mind. And they're like,
I joke that if I was white, I'd be canceled already.
Oh, man.
I'd get a little bit more leeway.
trust me, if you were me, because I can tell you what it'd be like. I say this stuff, and then they're like, Jason Calacanis has the #1 most racist tweet ever. And I'm like, I do? And they're like, yeah. And I'm like, what is the tweet? And it's like, anybody can learn anything. Everything is on YouTube now. And I'm like, I'm getting canceled. It's like, you don't take into account systematic racism. I'm like, this has nothing to do with racism. I'm just talking about the how-to videos on YouTube.
Yeah. And
MIT courseware. It's like,
yeah. I mean, I learned, I was employee #2 at Pinterest. How did I get there? From Singapore with no degree. I learned to code using Stanford's iOS development course, CS193P, that's available online for free to everybody.
yes, but
you don't have to go to Stanford.
How did you do that without an internet connection? Because that's the response I get. Or you didn't have a computer. You didn't have, and it's like, are you sure people don't have computers and internet connections anymore? Because they're free at McDonald's, and a Chromebook is $100/free.
Yeah.
And there's Wi-Fi for free in every cafe in the world.
Very privileged, but my parents did not. They immigrated from India to Long Island. Like, and I know you have your story and Chamat's and all these and Navals and Balajis and like I think a lot of people don't really realize like you have empathy for what they're saying. You've been through that. All they see is where you are now with your 11 home runs or whatever.
Yeah.
And I honestly think they just are they're just sad. They're just, it doesn't feel fair.
And 100% of the time, or I'd say 98% of the time, they're rich white liberals living in a coastal city who are saying poor people, specifically poor non-white people, don't have access to computers, don't have access to YouTube, don't have access to the internet. And I'm like, you can go to the Pew Research Center and see the percentage of people who have access. I think that you're basically saying that poor people are dumb or too dumb to get to an internet connection. Like, I think what you're saying is kind of racist. I know you're trying to be anti-racist, but what you just said is poor people don't have motivation. Are you crazy? When you're poor, man, you're motivated. Like when I was broke, I was motivated. That is a motivating thing for people. When you're broke and you want to get smarter and get better, I think there's just a gap between people even knowing where to begin. I think that's the actual problem. Because every time I talk to people, they're like, where do I start? And I'm like,
just Google.
Just Google how to do a startup and just read everything. And when we meet a founder who's figured it out, that's what they did. And almost universally, they say, I started with a Google search or a YouTube search.
Yeah, it's mind-boggling, but it is what it is. And I mean, I did listen to my own advice. It's not advice I didn't listen to, but it's like built, especially today. Like for example, if you're an aspiring VC for whatever reason, like first don't be, but if you are, like, don't try to go up don't climb the ladder. Like there's no reason to do this.
No, side door, man. Go through the. I always go through the exit. Go through the exit door, fire door.
Yeah. Get smart, write stuff on the internet, start a blog, go viral, show that you know what you're talking about, build an audience, tweet out that you have a rolling fund, and get started that way. Right?
And don't overthink it.
And there are some gatekeepers in the way, but like, I don't know. It's I really believe it's manageable. And I worry that if you just hear that it's not possible, like if you get this far, there's going to be a ceiling here. You're not going to be overcome. You're just not going to try. Right?
And that's
I
the
believe that I can
part.
do anything. Yeah. And I think that is a quality that Draymond Green said this, like, how do you be number one? Well, first you have to believe that you have the ability to be number one.
Yes.
And if you work hard, like, it'll happen for you. It's not going to be easy, and you're going to, but it's possible.
Trust me, he works hard. And then you look at like,
sure he works.
Well, I mean, and then you just, I was literally talking to the other day about like his goals for this season or before the season started. And he was really working on his passing. And he was talking about just, his understanding of the floor and his ability to, and I said, do you work like on one thing? He's like, well, I try to improve everything, but I do sometimes find something that I really want to get really good at. And mentoring Wiseman and some other players was a big focus of his, and his ability to direct the floor. So now you have Draymond Green getting 15 assists in a game. It's like,
the ceiling is, we haven't even gotten close to it in terms, and that's what I get so excited about is like how early it is.
Yeah.
And like, yeah, start planting those seeds, right? Like how many passes has Draymond made in the last, I don't know, a million? I literally don't know what order of magnitude, but it's more bad passes than you've had perfect passes, like, or vice versa, right? Like he's had more bad than you've had good. Like, I think you have to embrace that part. And I did, and I just think everyone should do it. And every time I meet a founder who's like, I wasn't able to raise from VCs, I'm like, well, what have you built? Have you learned to code? And often the answer
what skill do you have? Yeah. And they're like, no, I'm an idea person. It's like,
yeah,
congratulations. You and 7 billion other people on the planet who cannot stop thinking about every idea that rolls into their mind. Like, you get zero credit for ideas.
And now with crowdfunding, potentially you don't even need VCs, right? Arguably, if you can build an audience, you can now raise up to $5 million direct from your community of 1,000, 2,000, your 1,000 true fans, right? Like It's coming true more and more. So
it is literally like Kevin Kelly's 1,000 true fans theory, which was basically if you have 1,000 true fans, you'll never be hungry because you can do a comedy show or sing a song and sell it to 1,000 of them who will buy your $1 song or $10 comedy set.
Those 1,000 people are there. There's 7 billion people. So at least 1/7 millionth of the people will, should like your thing and hopefully find you.
Literally, it's so interesting that this essay that Kevin Kelly did so long ago is now reemerging. We just literally on the last week, Toby from Shopify, episode 1184, for those of you going into the archive, talked about it. And it was the 1,000 true fans has never been more true. And VCs are just candidly their funds are so big and it's so messy and so much work, as we talked about earlier with like founders just disappearing or, ghosting you as an investor. It's so hard in the early stages that VCs now are like, call me when you want to do an overpriced A. Literally what one VC told me, like, Jason, I don't want to do what you do. What you do is so painful. I want to go skiing. I want to go to Italy. I want to go to Tokyo. And I want you to do all the work, and then I will overpay you for your startups. I will literally give you $10 million for 20% of the company or 15% of the company, and you do all the heavy lifting, and I will mark up your book. But I do not want to make investments in 2-person companies anymore. It's too hard. It's interesting.
Yeah, if you have that capital, then you can start to make those decisions. But if you don't, you got to work really, really freaking hard.
And by the way,
try to get your points on the table.
Yeah, and it's kind of fun to it's kind of fun to play in this. I much prefer the arena of when there's, product market fit is just starting to click. To me, that's kind of the magic, is watching that all of a sudden click in. I don't know what your favorite moment is for a startup, but for me, it's when it's like, we got 3 people to pay for this and 7 people told us to go ourselves and bleep that out. And all of a sudden, but yeah, then these other 3 people said we'd pay for it. And then now we got 90 people paying for it. And you're like, what about the 7 people who told you to go after yourself? They're like, yeah, who cares about them? I got 90 people paying for this thing. It's working. And you're like, you figured it out. You don't have to get everybody. You just need to get somebody to care. It's such a great industry.
That happens like one time per startup per 10 years or something. You need one. You only need one. Need one.
That's the name of my autobiography. You only need to be right once. The Jason Calacanis story. Sahil, I'm glad we got to do this. You're a champ. And congratulations on Gumroad. Congratulations on equity crowdfunding. Congratulations on rolling funds. Congratulations on a big social media following, to wetting your beak in Clubhouse. Lots of great things going on for you. And let's make sure we NFT these oil paintings, because the Sahil oil paintings from that dark era, I don't know what's going on in those paintings, but do they go from like darkness to light over time as your head cleared? I don't know.
They actually do.
They do?
They actually do. Yeah.
It was like
it's pretty
stormy
crazy.
nights and mud, and just banshees and horrible creatures in the woods. And then all of a sudden it's just beautiful hay fields and sunsets and rainbows.
Yeah, I don't know if I became a better painter or if I just, got happy or something, but probably.
You know what? Happiness just kills art. I mean, I know so many artists who got happy, and it's just like production was like, meh. They're like, life is so good. Why would I go to the studio? Enjoy my life.
I was talking to another founder about this who just started a rolling fund, and he's like, man, I don't know if I would ever. I'm like, I'm so glad I did it this way. Like, I'm never starting a company again. Luckily, I already have one, and but it's like, man, after this, it's just like, do I really want to go back into that?
It's very hard.
I don't know if I have the energy to do one more. To be honest, I'm glad I'm still on my first, and I'm like, oof, it's when someone does multiple companies in a row, I'm like, wow, you're
a masochist.
I have a lot. Yeah.
For some people, for that feeling of the insurmountable odds is the feeling to get up in the morning. For other people, the insurmountable odds, it's like great to have done, but they don't want to climb Mount Everest the third time. It's kind of like I climbed Mount Everest. That was an interesting experience, but I like oxygen and I like not dying. So maybe I won't go to the top of the highest peak, lose oxygen, and crawl past dead bodies that nobody even has the energy or, effort to take down from the top of the mountain. You ever see all the dead bodies on the way up to Everest?
Oh my gosh.
That's basically startups. It's basically startups, except you don't actually die. You just have your soul crushed. So, and did you ever see the line of people in line on Everest?
Oh, yeah.
I mean, it's like, what are you people doing? You people are insane. And I just thought, I put that in my fundraising deck. I just showed the line. I was like, this is what we do. See all those people in line? We give them the money to do that. I showed the dead people.
I wish I might, if I could go back in time to answer your question, I wish I showed Series A Sahil being like, you are actually quite far up, but there's still a lot of dead people ahead of you. So like, you're not.
Congratulations. You're in line. 1 out of 20 of you are going to die. And it's going to be brutal because you're going to die of a lack of oxygen. So you're literally going to suffocate while you're freezing to death.
Exactly.
Still want to go up Everest? Okay.
Then do it. Yeah, exactly.
This has been another amazing episode of This Week in Startups. Congratulations to founders on your journey to certain death and pain and suffering. But you never know. Could be glory. You could get that snapshot at the top of the mountain. You could ring the bell on the NASDAQ. Who knows? All right. Great catching up with you, Sahil, and continued success. We'll see you all next time on This Week in Startups. Bye-bye.